the third quarter of 2025, stock market gains were concentrated in a limited number of companies and sectors. In the US market, if we took each of the 500 companies in the S&P and gave them the same weight, the third quarter performance would have been 4.8%. In reality, the market-weighted S&P 500 is up 8.1% this quarter. So what explains the difference? It comes down to concentration. Just 3 companies, Nvidia, Apple, and Google, together contributed close to 50% of the index's performance in the last 3 months. Over the past decade, the top 10 companies within the index have steadily grown in importance, from representing 20% of the weight in 2012 to nearly 40% of the market this year. A similar story played out in Canada. Gold miners drove nearly 40% of the quarter's gains, and the large banks nearly 30% of the quarter's gains, leaving much of the broader market flat, including many of the high-quality companies we own with solid fundamentals, such as Canadian Pacific Railway and Dollarama. The environment temporarily penalized portfolios built around diversification and long-term value. The outcome reflects our investment philosophy by design. We invest in stable businesses that grow earnings over time, and we maintain diversification across a broad set of opportunities and sectors, rather than over-concentrating the portfolio in a handful of stocks or themes. The same diversification philosophy helped shelter our portfolios during sharp downturns earlier in April around the new tariff proposals. Moving to fixed income. With inflation easing and central banks cutting rates, the outlook for bonds is improving, though we remain cautious. The prospect of lower rates is supportive for bonds because when interest rates come down, bond prices go up. However, interest rates are only part of the story. Credit risk, which is the extra yield investors earn for taking on non-government debt, remains near historic lows. Against this backdrop, we prioritize capital preservation, limiting exposure to lower quality company debt while capturing attractive income opportunities in highly rated securities. Looking ahead to the final quarter of the year and towards 2026, we do see reasons for cautious optimism. Policy and trade uncertainty have eased compared to earlier in the year. 2, central banks are moving towards a more supportive stance. And thirdly, corporate earnings growth does remain resilient. On the flip side, some factors could induce friction into the market over the coming months. Labor market softening could impact consumer spending, global trade tensions could resurface, and elevated valuations in certain sectors, such as technology, leaves less margin for error if fundamentals disappoint. While market volatility is always to be expected, the combination of steady earnings growth and more supportive monetary policy provides a constructive backdrop for diversified, high-quality portfolios. On behalf of the TWM Group, thank you for your continued trust, and see you next time.